Hello, options traders. Steve Ganz here, and I want to share something with you. I've shared this a few times before, but you're going to get to see yet another successful hedge that I put on to this AVGO trade. Now, as many of you recall, if I come back and I take a look at my saved trades here, I have my AVGO long calls, and I bought these a long time ago. These were leaps. And I have 10 of them, and they're up about $120,000. Now, what I've been doing though is I have been adding hedges. I've been selling call spreads against this long dated call. This doesn't expire until January 17th of 2025. And I've been selling shorter term call spreads at opportunistic times. So what do I mean by opportunistic times? Well, if we take a look here at AVGO, back on the 17th of October, AVGO was trading up here at its all-time highs. Now, I certainly could have been wrong here, but my assessment at the time was that AVGO is probably overextended and hitting this pressure that it's running into where it has stalled before and backed up. So I come in and I sold a call spread. We can see that that high here is around 186. So what did I sell that trade at? Let's see here. Okay, that's just the long call. So I sold that third call spread at 185, 195 spread. Now, I sold 40 of these, and we can see that that gives me this pattern. So long as we stay below this 185 range here, where this short call is, I'm going to pick up quite a bit of theta decay, which will juice or boost this trade. Now, I can come in and take a look and see how I did on this. My cost basis, I sold these for $5.50. I'm going to go ahead and close that out now. I don't really need to, but just to show you what I would do in this particular case, I'm going to close those out for 29 cents. So that means that I picked up $5.20 and times 40. So that's what, $20,000. But I also, to protect myself against an upside move, I had to buy these at $2.69, and those are essentially worthless now at this point. So after you take a look at all of that, the $2.50 here that I essentially lost, and then the $5 I picked up, so that's roughly $2.50 times 40. So that's about a $10,000 boost that I picked up in this hedge. And that's why if we take a look here at if I just had the long call, I would be up 120,000. But by coming in and selling that spread, basically as the market backed off a little bit, the amount that I lost in the value of my long calls, I gained off of this spread, giving me a little bit of a boost, if you will, to the overall P&L. The other thing this did for me, it's essentially a hedge where we can see that my delta here is 670. Now my delta for 10 long calls by themselves is going to be 1,000. So I have delta hedged this position. What that means is if the market rips up from here, well, this position is going to be gaining much more rapidly than this position would. But this position has theta decay in it at the rate of $630 a day right now. And so therefore I'm picking up theta decay. My delta is less than 1,000. So that means if the market rips up, I'm not going to make money quite as fast here. But at the same time, if the market sells off, I've got this acting as my hedge, which is bringing money into the trade. Now, these all expire here at the end of this week on 11/15. So my game plan going forward is I'm going to set an alert here on AVGO up here around 184 or so. If AVGO gets back to this 184, I am going to look at the market and AVGO at that time and reconsider whether or not I want to add another call spread into the mix. So just wanted to share this as part of the ongoing start to finish trade, specifically on AVGO. Take care, everyone.